So speaking of the cheapest part of the market, I did want to give you an opportunity to chat about your fairly recent uh, article series on value investing.
Yeah.
So maybe just state the general thesis there, and I've got a couple of general questions maybe that might flow from that. But I thought it was a really interesting series of papers, and so it's worth exploring. So what are you trying to say?
Well, in really simple terms, what we're actually saying is that systematic value is distinct from, the individual stock picker who's going and finding, the undiscovered gem that is just waiting to be picked up by, Wall Street, right? Or revalued by Wall Street more accurately. But systematic value investing, where in simplest form, you're buying the cheapest third of the market, selling the most expensive third of the market, and counting on the forces of mean reversion to generate a source of alpha or excess return relative to the market. Like, that's just a short vol trade, right? And that's really what that whole series of papers was built around, was demonstrating that what was actually happening can be replicated by synthetically selling puts and calls on each of the individual components of the indices themselves, right? So what we literally did was walk through the dynamics of how value generates its excess return, and then reprice that in the framework of what would happen if I agreed in advance to sell a call option on anything that outperformed and sell a put option on anything that underperformed, which is functionally what you're doing with a systematic value strategy, right? You're agreeing to buy something if it falls in value, and you're agreeing to sell something if it rises faster than the market in total. And so, one of the things I would point out for simplification purposes, we price these as if they were vanilla options. Technically, they should actually be outperformance options, both against the index and against the fundamentals. That's a lot harder to price. And so when you're doing it, we did it on, I want to say roughly 1,600 stocks, right? So to turn that into an outperformance option would require some pretty heroic calculations that candidly me and my beta fish on my desk are not prepared to do. But regardless, you end up, when you do it in aggregate, actually with a number that is very, very similar. And we're able to explain basically the entirety of the value premium, right, with that type of behavior, and also explain the underperformance.
So I think it's worth going into a little bit more detail on the underlying mechanics of your option framework, right? So there's two dimensions to it. One is size and one is book to market. So first of all, is there anything special about book to market? I know you did go into some detail on some of the flaws of book to market and how some of those flaws have become especially prominent or impactful in the modern era. But does the same basic framework and then prognosis for value apply if you use different value metrics like PE?
It does. Yeah, it does, for the very simple reason that if you actually were to disaggregate the source of volatility in the book to market phenomenon, right, all of the volatility is contained on the market side, right? I mean, it's very rare that book changes by any significant.
Same is true for earnings and for cash flows. And
yeah, I mean, and that's actually part of the reason why I would argue that book to market had the most demonstrable impact in the past, because it's actually the slowest moving, right? So sales changes more rapidly than book value does for the most part. Earnings change much more rapidly than book value does for the most part, right? Because at best, your book value should reflect some compound component of your earnings less dividend streams, right? And so you basically are just isolating more and more of the volatility by moving to a book to market, right? You're isolating more and more of the volatility in the price, right? And again, that just reinforces the idea that what you've actually done is just synthetically sell options. If you're generating the source of your return through the price framework and your behavior is largely determined by the price component, well, then it's just an option.
Right. So, okay, so let's walk through an example. So you've got a small value stock, and you do a great job of this in the paper. I'm trying to recall it because it's been a while since I've read it. But
it's been a while since I read it too. But the just very quickly for anyone who's watching, if you wanted to go to logicafunds.com, it's available on our research page.
And there's 3 parts of the series, and I'm sort of digging into part 2 now because you guys actually went into the underlying mechanics of your options framework. And so the idea is a small value investor will sell a stock if it moves into, either it goes up into a higher market cap category, or it goes up into a higher book to market category, right?
Right.
And so you've got in large value has sort of a almost an opposite profile where you will buy it if it goes down into a smaller market cap category. So you've got all these different categories and different buy sell agreements essentially based on whether they move from one category to another, because systematically you've agreed to rebalance into stocks of these characteristics, right? And so you're synthetically creating an option series that for every stock based on its category in each period to reflect the net premium or that you either get or pay from holding a stock with these characteristics. Am I
Right. Yeah,
getting
no,
on
that's
the right track?
no, you're on exactly the right track. I mean, the easiest way to think about it is that there are more categories that can migrate into small value than can migrate into large growth, for example, right? Or it is harder and less frequent for those migrations to occur. And so almost by definition, the options that you're selling or buying in those scenarios, right? Because when you buy a small growth portfolio, to a certain extent, you have sold fewer options than you have sold if you're in small value. Large growth sells fewer options than if you buy a small value portfolio, right? And so the differences between those largely explain actually the differences in performance over time.
So basically you are selling Vega, and it's the number of it's the number of options that you're able to sell Vega on that dictates the size of the premium. Is that generally okay?
Yeah, I mean
Or discount.
correct. I mean it's an easy way to think about it. Effectively, if you are buying small value, you are selling more options than if you do large growth, right? And that's when you look at what's called the migration frequency, the propensity for stocks to leave that bucket or enter that bucket. That's basically what we're calculating. And again, it reverses into telling and explaining the value premium, the small and value premiums that we experience.
Right. So you're multiplying the expected premium by the probability of migrating from one category to another. And that's generally how you get to which I think is really, really intuitive, actually. And I was, on the one hand, really astonished by how well this options-based framework mapped to the empirical results. It's especially for small value, the expected premium from the options selling thesis was almost exactly the same as a realized premium from the from a small value strategy.
Which to be clear, right? I mean, there's a stochastic component to that. Like over the time period that we have, you would expect the two to converge, but at any point in time, right, there's a highly stochastic dynamic.
Oh, no question, for sure. And you're
also
assuming different migration probabilities,
exactly right,
will happen over the long term, but not over the short term. And
but that's actually one of the interesting things that comes out of it, because under a passive framework, right, you actually would expect far less migration. Right, things effectively become frozen into their relative positioning, and as a result, the returns associated with a strategy that relies on those migrations or the risks of those migrations, you would actually expect it to fall.
Okay, so that is really fascinating.